Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. My name is Lars Fontin. I'm your host. You're watching Cycles TV. Today is Monday. We are live, another episode of Cycles TV. Today, the purpose of today's question is about your questions, your most important questions. I received during the last weeks a lot of questions. I will not be able to review each individual email, so we sorted it a little bit, we prioritized it, and there have been three important questions during the last weeks, which I think are relevant for the whole cycle analysis community. And that's the purpose of today's session. We will talk about MIQ, not an FAQ. Most important questions. Yeah, so that's the purpose for today. I just try to use this synchronym here. I've picked three key topics for today. So we will not review current market data. Just watch the past two sessions where I did that. Next week, we will get back to the markets. This week, the next 20 minutes, if you are in cycle analysis, there's something that you really need to take into account. And that's the purpose of today. Maybe you know it already, then it's good to see a repetition. If you're new to cycle analysis, that's something very important related to the questions here. So let's get into it. I will now guide you through the questions. As we are also live, so at the end of the sessions, there's always the chance to bring in your additional questions, or during the topic, if you want to have additional clarification, let me know in the chat. Question number one, which was just sent in during the last days, and was related to the analysis we did last week. When I put in the exact same time frames from ending 4th of January in the first analysis, and then the second analysis ending 23rd of January on the cycle scanner, does the cycle change? I would have thought the cycle arcs would have remained fixed, as well as the data, only adding new data to the existing cycle. So that's related to how you apply cycle analysis in the cycle scanner, and it was related to the following screenshots here. So this was the first screenshots which a community member just sent in here. The important points to keep in mind are here. I'm highlighting this with my mouse. This analysis was done ending the 4th of January, as highlighted here in the red box, starting somewhere 20th of August, including these 850 bars. The point of the analysis, as you see here, it revealed a dominant cycle of 80 days, which is shown here in the top. This cycle is shown here via the arcs, and it's indicating a low 25th of January. I think that's here. That was the analysis done on 4th of January. So, and then the user redid the analysis 3 weeks later, and then the following picture appeared on the, give me a second, on the cycle scanner. So this was the same data set which was used here. So in that case, you see now we have approached the 23rd of January, so last week, so approximately 3 weeks after the initial analysis. And now the dominant cycle, so the same cycle length showed up with a dominant cycle length of 80. Now we have additional data, which was added because we progressed 3 weeks in the data set. So the same dominant cycle here is shown, but now it indicated a low on the 4th of February. So, and then this induced the question here. So assuming, didn't the cycle should have static or fixed, and just additional data has been appeared? And this is a common question related to how the cycle scanner works. So therefore, let me guide you through what happened here on the cycle scanner. First, you see it's the same cycle which has been found. So, and you reapply the analysis. So once new data is added, the cycle analysis is redone. Yeah. So if you open the cycle scanner 3 weeks after you've done an analysis using the same data set, for sure the results might change because we have new data. So if we switch forth and back between the initial analysis you did here, or which was done on the 4th of January, the low was projected for end of January. And if you do the same analysis 3 weeks later, which is done here on the 23rd of January, we have new data, which might be then subject to finding additional cycles. But here in that case, you claim it's the same cycle. So, and that's right. So in general, it detected the same cycles. So there's no new cycles which have been identified. It's the same cycle with 80 days. And now the question is, okay, but why then in the initial analysis, the low projection was 25th of January, and 3 weeks after identifying the same cycle length here, now the low projection is 5th of February. So it shifted 1 week into the future. Why didn't they say static while still using the same cycle of 80 days? There could be 2 reasons now. And the reason here in this specific case, so let me first answer this specific question here. And therefore, I will now open the same analysis in a real cycle analyzer configuration here. So I've now switched to the cycle analyzer using the data set which was shown here. I've opened that today, so it has the latest data, and I've just gone back to the initial analysis. So using here, give me a second, I need to organize my screen here a little. So going back here to the 4th of January, aligning the low of the analysis to the 20th of August. So exactly the same data set which was used on 4th of January as you did the analysis. But there's one very important difference here. So because if you, and you can do this on your own, if you redo the analysis today by aligning the end of the analysis here, so you can do this by resetting here the end of the analysis to this point here. So you can redo the exact same analysis and it will find the exact same cycles as you would have identified on the 1st of January. So now, and even to make it more confusing, this identifies the 3rd of Feb or 4th of Feb as a possible low, exactly what you're claiming in the second analysis. So you might now ask, why on that chart is it showing the 3rd February or the 4th February as a low, while your initial analysis you did on the 4th of January projected the 24th of January as a low? And the answer is quite simple. And it's not an error, so it's quite simple and very important. So therefore, let's get a little bit closer into the analysis here. So let's start. So this is the last point in time, not used for the analysis, but the last point in time we have possible data available. It's today, yeah? So, and it would have been the 4th of January once you did this analysis. And for the previous data, you have real data points, which means trading days. I think this is, if you don't readjust the input data or the pre-processing of the data, the left-hand side of this chart will give you the data as it has been given by the data source. And in that case, it's trading days. So the weekends are skipped here. Yeah, if you browse through the data, you will not find weekends in the real data set. So now if you move forward in time and check what are the days now on the right-hand side, if you don't change anything, you can check this. It will then go in the continuous future with calendar days. Yeah, 4th, 5th, 6th, 7th, 8th, 9th, 10th, 11th. So you need to tell the cycle scanner what kind of projection and historical time frame to use, because if you don't adjust anything, it will treat the historical data just as it arrives, and it will treat the data in the future as every calendar day. So if you just use daily data, it assumes, moving into the future, that we use calendar days to not skip any day, because we're talking about days. So future projection will be calculated in days. If you then just load in data which has gaps on calendar days, so just trading days, in the past you have a different using trading days to feed the cycle scanner, and on the projection area you use continuous daily charts, which will then might generate an offset. And that's exactly what happened in your sense, because in the case of this analysis here, that's the topic, we already have additional data for the current past, so for the last 3 weeks. The weekends are bridged because we don't have data on the weekends in the last 2 to 3 weeks. That's the reason why the current projection is similar to what you have received on the 23rd of January with your analysis. If you go back to your analysis on 4th of January, I would assume the future is then continuous calendar days. And that explains the difference in your initial analysis. And let's get back to the screen. And I hope I could explain it to you. In the initial analysis, let's switch back. In the initial analysis, which was done here on the 4th of January, yeah, from that point in time here, we had counted calendar days into the future. But if you have additional data which skips then weekends, the calculation changes. Yeah, exactly, and yeah, exactly. That's now important, and that's I just monitor the chart sections. So and if you would remove the weekends and add them up into the future, so I think there are 2 or 3 weekends in between here, which are still in this data set here, but on the left hand side you don't have weekends, so you would skip them, and you can then add 4 or 5 days on top of that. You would also arrive at the 24th of January. I hope I explained it the right way, or you need to review it maybe sometimes, but that's important. And if you want to correct that, you need to tell the cycle scanner which time frame you are using. And now let me show you where to do this. So you go into the settings, you have the pre-processing settings here, which you can adjust. And then the important section is fill missing days daily. So if you have set it to none, which is the standard configuration. So in the standard configuration, the cycle scanner will do nothing. So it will treat the incoming data as the outcoming data. And if you load daily data, then it will not change your data, and it will assume it's calendar days. If you are dealing with more or less trading days, which is here more labeled as weekdays, because there is no real trading day calendar behind, because therefore it's just on the daily chart, just weekdays, so Monday to Friday, because it's not really referring to trading holidays, it's just using weekdays in that case. So if you're dealing with more or less trading days on daily basis, you should set it to weekdays, which ensures that also the future projection, and that's now the important setting, it will not change anything in the past because you have weekdays data for your data you're feeding in. But now the cycle scanner knows that it should skip the weekends if it is doing a projection into the future. And if you would have set this at the day of the 4th of January on your analysis, I think it would have shown you the same low projection on the 4th of February instead of the 25th of January, because the cycle lengths would be the same in terms of days. So, and if you skip the weekends, it would have been exactly that. So that's an important setting when dealing with daily data and you're dealing with financial trading day data sets. The cycle scanner is generic, so the cycle scanner allows whatever to load. You as the user need to understand what's happening there. So the pre-processing here is very important. So once I update the pre-processing, now the change is here. You remember, as I've continued browsing into the future, so the last data point is here, today, 13th of January. If I now go into the future, we have, I need to do a projection. Wait a second to have future data, whatever here. So if I now want to move into the future, you will see that moving forward from today, so then we have 31st, then we have the 1st Feb, 2nd Feb, 3rd Feb, and then you see it's skipping the weekend. So it's Friday, 3rd of February. And then, because we have now set it to trading days, weekdays, the next day is Monday, February 6th. Yeah. Now in the projection area, the length setting is the same as in the historical analysis. So, and if you would have done this in your analysis on the 4th of January, then you would have the same low on around, I think it was 4th of February, as you have seen it in the 23rd analysis. So that's an important setting in the settings chart. And way to make this more easy to use is that you can create standard profiles so that you don't need to reset it every individual analysis. So if your main purpose is analyzing daily financial data sets, which mainly use trading days, which in most cases refer to weekdays, then you would save this as a standard setting, right? So what you can do in order to do this is you can save this as a profile. So you go into the configuration as I showed, set this to weekdays if this is your preferred standard or your default configuration for your specific scenario. And you can save this either in profile 1 or profile 2. We offer 2 profiles where you can store your settings. But you need to click set. So now once click set, this is now saved in your profile 1. And to change it, I can also make a profile 2. You see now profile 2 is not set. And if I switch to profile 1, it's weekdays. And as I've now done this, you can easily change between these profiles by just changing here your standard configuration, profile 1 or profile 2. Yeah, so now you see that the analysis is now changing between, or you can simply click or change between these profiles. And if you get back to the analysis, you will always see that if you stay on profile 1, the default setting is now weekdays. So regardless of which asset you open, or if you just come here another day for the cycle analysis, profile 1 has weekdays. So you don't need to remember this from time to time. This is your default setting. But as said, the cycle scanner is generic. So that's why I wanted to get back to that question. And I hope it gave you an answer here. Otherwise, feel free to reach out or send in a follow-up question. That's the first important question we received, and it's referring to a very important analysis. Another question, which is very important in relation to analyzing cycles. So let's switch to that question here. And it's referring to what we did last week here in regards to Apple. For the analysis of Apple, you rejected the 300-something cycles as it has a flat plateau only. But in the Bitcoin analysis I picked the 200-day cycle, which also has a flat plateau and even seems to merge with the larger one. Why? So the question of the user here is, why is the Bitcoin cycle okay, but the Apple cycle is not okay? So therefore, very valid and very good question. And it shows me that you're really trying to understand what we are showing here. So therefore, let me try to give you the answer here. Of course, in the end, there is an obvious answer. So just maybe summarizing the question with some pictures here. So this is referring to the analysis of Apple we did last week here on the channel. And I told you that I would not use this cycle here, which is highlighted with a length of 300 something, because the peak in the spectrum is a very, very flat peak, yes, or it's a plateau-like peak here in the spectrum. If you compare it to the other two peaks here, which are more clear peaks in the spectrum. And I explained that, therefore, use these 3 cycles and skip this cycle here. And the question was referring to a Bitcoin analysis we also did here on the channel with this spectrum here, where we also have 2 peaks in the spectrum here, one at 200 and 100 and one at 300 something. And you could argue similar. So these 2 peaks are also very flat in regards to the shape of the spectrum or the peak in the spectrum. And then for sure, it's a valid question to ask why, in case of Bitcoin, it was allowed to pick the cycle with a length of 200. While I argued in the Apple analysis not to pick this cycle here. So let me give you an answer here. So first, this is still, or this is the valid prioritized approach. Ignore flat plateaus in the spectrum. For Apple, it was quite simple because there have been 3 other clear peaks in the spectrum. So there's no discussion that you first go with these 3 peaks here and the amplitude level is even similar to this one here on the right. So if you have similar amplitudes, but with a very, very good shape in the spectrum, you start with 1, 2, 3, and then you can argue use it as a 4th or not. But if you have already 3 peaks in a spectrum which look promising, maybe there's no use in adding a 4th one. But that's always the priority of the framework to decide which cycles to peak. And if we now look into the Bitcoin spectrum, the first argument I would make is there is no other clear peak to pick here. Yeah, so that's the difference in comparison to the Apple spectrum. In Apple, we had 3 clear peaks on the same level, on a or similar amplitude level as these 2 ones, the plateau peak here. But in Bitcoin, we don't have any other peak here to choose from. So if I would have seen here other peaks like 100 something with a good shape in the spectrum, then I would prefer these ones. But the only possible cycle peaks here in the spectrum are so low from their from their amplitude. You can see it here. So the amplitude here of all the other possible cycles is so low compared to the offset of the amplitude here. Yeah. So there's really no discussion, not pick anything here. So the only 2 cycles we are left with, if we want to use something in Bitcoin, are these 2 peaks here, as explained. Or the other way, I would like to have seen here some peaks which have been clear shaped on a similar amplitude level, like we did it here in Apple. Yeah. So as I try to explain here, this is the amplitude level, and you have 3 peaks which have a similar amplitude level. So it's clearly seen to prefer these 3 cycles here. In Bitcoin, we don't have any alternatives besides these 2 here. So that's the first argument why we could only pick between the 200 and the 300. And for sure, it's not the perfect visual shape you want to have in a spectrum, because you want to have the clear peaks in the spectrum. But there's another very, very, and even more important argument why I picked the cycle with a length of 200. I did a very long-term analysis of Bitcoin, and I explained this analysis here in the session when we did the Bitcoin chart, where in each historical move of Bitcoin, there has been a cycle with the length of around 200 days. So, and that's also important. You need to have done your, I would call it homework on the asset you're working on. So you should be aware of in the past behavior of important turns in the asset you're reviewing, if you know from historical analysis that there was always a cycle with a length of 200, I called it the nominal cycle of 200 days in Bitcoin, varying between 180 days to 220 days, it has always been there in past important turns in Bitcoin. And that's then the second most important argument. Yes, the cycle is still there, even though this single analysis, I mean, this is a static analysis of one point in time. So at the current point in time, it's a very flat plateau. But if you know from the historical data, yeah, there was always a cycle with a length of 200 in the data set at important turns. This gave you then confirmation, yes, the nominal cycle with a length of 200 is still there, even though the spectrum is not perfect. But based on the historical analysis of this asset, you know that you can trust cycles with a length of 200. I mean, it could merge with a longer term cycle, so we need to monitor how this evolves into the future. So maybe these two cycles, might merge into another one, but we need to monitor that. But that's the second argument why in the case of Bitcoin, it's okay to pick this one. So just quickly summarizing, because there is no other alternative available here from the spectrum. So if there would have been clear sharp peaks here with similar amplitude level, for sure, pick the other ones. They are not. So these are the only two. Why 200? Even it's flat, because in all historical moves in Bitcoin, 200 days was available. And that's exactly the reason you need to put these different ways of, trusting cycles, picking cycles from a spectrum into account. And that's why I always try to use live data, because the framework we are using here is always the same. Yeah, go to the spectrum, look out for the peaks, use criteria like strength, Bartle's score to pick the important ones, try to build a composite of 1, 2, 3 cycles, max 5 cycles, not more. And you should know the historical rhythm of the data sets to be aware of which dominant cycles have been there in the past, which not, which give you more confidence in picking cycles or leaving out other cycles. So I hope that explained the question you had in relation to why the Bitcoin cycle is okay and in the Apple cycle not. Okay, so that's the answer to that question. So let's get first to the third example I want to quickly review, because this was, I think this was a community question below a video. Maybe I'm not really happy how it's phrased, but I think the underlying question is absolutely valid. Okay. This question is related to. Let me show you the example here. So it's related to a question. I think I extended the data from September to 23rd, so the analysis last week here on the channel. And then when you as a user open the cycle scanner, it just shows 850 bars. How is that? And that's also a default setting if you switch to the scanner. So let me explain this. This is the basic setting. If you open a chart or a data set with a cycle analyzer, it will always use the standard historical amount of data of 850 bars. From the current point going into the past, it will load 850 data points. I mean, you can adjust it to your own needs. You can load more data, you can adjust the starting and end point of the analysis, so you're completely free how to fine-tune that. But that's the starting point, the default setting of the historical days. So that's the reason when you use the same data, or Apple in that case, and open it, by the way, regardless of the day you will open it, it will always show you 850 bars. That's the answer here. So the analysis you did, and the screenshots I received here in that example. So here it was shown that on the 23rd, so I think on the same day I did the video, you open then Apple in the cycle analyzer, and this is how it looks like. And even if you would do this today, it will again just show 850 bars. Yeah, and I did this here, 850 bars, and I did it in the video. This is the screen you're referring to. I did the video here on the 23rd on the same day, using a little bit more history here, so 30 days of more history, but it was just because I used the previously saved Apple data set. I just didn't open it freshly. I used the previously saved workbook, and then I used additional data to analyze it. But you will see, if you compare the cycles which have found just by using slightly more historical data, 30 days more, and your analysis you did on the same day, the cycles which have shown up have been exactly the same. And the projection which you have come up with is exactly the same in regards to the conclusion. So don't get irritated if the cycle length just changes by 1 day. So instead of 81 showing 82, or instead of 135 showing 136, important is the conclusion about the future turning points, which is in that case, and this was my summary of the analysis we did here last week, that Apple might continue into the March. And you had the exact same result of your analysis. So you should not be frightened about, why there have been 20 or 30 days of data, more or less what I used. The result is exactly the same in the composite cycle forecast you did here with your data, what I showed on the channel last week. So, and that's even more important. So you have the same conclusion, the same result if you use the cycles for the dominant cycle projection as you have done here with the 3 cycles, which are shown here on top. And I used exactly the same 3 cycles by just using 30 days of more historical data. So, and it's, to be honest, no surprise that you come to the same conclusion. And that's just the answer why, if you open a data set fresh from a non-saved workbook, you will have the 850. You can then save this data set as a workbook. And if you open the workbook the next time you come, it will always use the same starting point in the past. And then you can add up more data as new data comes in. And this is what I did. That's why I had the 880 instead of 850. So that's the third question. And I was wrong. I have a fourth one here, which I think is then the final question for today, which is also related to dynamic cycles. I always use the phrase dynamic cycles here, and we're talking about time cycles. So, but let's first get to the question here of the user. And you will find this question in, I think, a comment in a video. So I have just used the question here to explain it. Okay. In the video on end of October, short-term cycle projection of the S&P showed from mid-end November downtrend into end of February. Okay, this was the result of a video we did here in October. Then 1 month later in November, we used similar data set. I don't know. I'm just repeating here what the question was. There might be positive movement in January. From end of January, we are rolling into negative situation in June. So this was the information in November, that we might still continue to move down in December, but then in January, we could see a positive movement in November. So now I think end of January, last week, so 2 months later, now large cap Apple showing up till mid-late March. The question then at the end of the comment is, so is that we are getting contradictory indicators with just this 2 months of time frame, as November showed something which changed in January? Am I missing something? Yes. So first of all, I mean, you need to update the cycle analysis. And isn't this a beautiful picked example of where I guided, or where cycles guided us through the markets? So the long-term analysis, and still in October, where a lot of people have been looking for rally in the markets. I showed you with the short-term cycles. Yeah, let's just repeat the upper one here. That's still end of October. That November, December are pointing downwards, even into February. But from a cyclic point of view, you're still interested in the current future for the next turning point. So for November, December, the 2 months following the analysis, I clearly told you cycles are pointing down. And this is what happened. I think until end of December, markets have dropped. So this is the first analysis you're referring here. It was spot on to what happened 2 months afterwards. And then for sure, you need to update your cycle analysis, as I did here in November. We revisited the situation. And then, the cycles told us that the cyclic situation has changed in the case. There is no change until end of the year. So late November, there was still the situation, markets could drop in December, but then in January, there's a change. Now in January, we could already see that in January, markets could move up. And what happened? Who has forecasted the rally in January? Already in November, we did it here on the channel. Cycles did. So now in January, we did an update here. What is the situation? And this shows you now that this rally could extend into March before we then drop afterwards. And to be honest, if you want to get a better example of live analysis where cycles really guided us through October, November, January, then that's it. Here you have it. And I don't know what's really the problem here is. Instead, you should never follow a static forecast. So if you have blindly followed the initial forecast, then you would have missed the rally in January. But in November, this rally has become visible. We told you here in the channel. And now the situation is we don't know what happens, but it looks like this could extend into March before the larger move down continues, because, the weekly cycles are still expecting a low then later this year. So it's not about contradictory indications. We are just updating the dynamic nature of cycles, because cycles never stay static. So if you do an analysis 1 year ago with a static projection into the future, you should never treat all the changes of the cycle as static projection. They will change moving forward. So that's why you need to update your cycle analysis every day, every week, every month, for sure. And this is not contradictory indications. In that case, it has shown us that the projected low, which was originally February and October, has come end of December and beginning of January. And we have seen this 4 weeks in advance, end of November. Yeah. So therefore, no, you're not missing something, but it is about updating dynamic time cycle analysis every day, every month. And the examples you picked here are perfect examples, but because they proved to be spot on. So that's my answer to dynamic time cycles. And maybe to finish this session off here, what are dynamic cycles? I have also some videos which I did in the past to explain the dynamic nature of cycles. And let me just update here and just show you the videos. And I will try to explain a little bit the main purpose of what you're seeing here. So the first one shows you the dynamic nature of the phase of the cycle. A cycle has 3 parameters which could vary: phase, length, amplitude. The phase is what you see here as the red cycle. So the line here, the black line you're seeing here on the screen is indicating today. Yeah. So on the left side from this line, we have the historical data, which has been used for the analysis and the cycle detection. And on the right part of this line here, it's the future. That's where we do our projection. Yeah. So this is the time axis here. And you see the gray one is the initial cycle we detected, which is more or less static, just plotting it into the future. But you see now here the red one allows the phase, so the offset where the exact low or the exact top is, to shift. So the cycle length stays exactly the same. Yeah, so length is the same between the red and the gray one. It's just that where is the low or the top in the past starting might slightly change. And that's one dynamic variable if you are working with cycles. And you can see if you move into the future, for sure, the projected tops or bottoms could change slightly due to changing phase of this dominant cycle. Yeah. So this is one impact of the principle of cycles variation. The second principle, which is even a little bit more important coming to cycles, is about the cycle length. So in this example, we have the same setup here, but instead of varying the phase now, we slightly change the length of the cycle. Yeah, you see here the gray one is the initial detected cycle, and the red cycle is now slightly using a different length instead of the original cycle. So, but it's still the same nominal cycle we are seeing here. We are just slightly adjusting the length from minus plus a little bit here on this cycle here, and this variation here is very important moving into the future. So I will pause here for a second, and I try to, oops. Okay, and I just need to close it. So let's have a look here on the left top of the start of this cycle. You see here that the deviation of the length, or you can see it here, is in regards to where the top and the bottom projection is. The deviation is very low here between the real low and the projected low. But this error or this length variation now moving into the future, so this adds up with the next and the next cycle top here. So if you go even further into the future, so on the right hand side, you see that the top projection of projecting this cycle with a varied length into the future and the theoretical cycle here has now a significant difference here. So it's a kind of if you have an error or a deviation of length, and if you have more repetitions into the future, the error or deviation will even become larger the more you go into the future. And that's why you should never read a static cycle too much into the future here, because the error or the principle of variation will get you really into deep problems if you treat this as a static cycle. So, and as this cycle also, this is the same cycle now in real life. It will vary in length, and at each point in time, therefore we should not take this as a static projection, like this here when I stop here. You need to update because the length might change tomorrow or next week, and you want to have the current length of the cycle, not the cycle length 2 weeks ago, which might give you a different projection. So they are not contradicting, they are just updating. That's the nature of dynamic cycles. That's not based off the cycle analyzer. That's how cycles are in the real world. And unfortunately, we have both in parallel. So this video now is a combination of changing phases, of varying phases, and varying length. The amplitude is the same here. So here you see the principle of variation of a cycle where length and phase could change. And you can now observe on the left-hand side, so in the historical view of this data, this is always an almost perfect fit here. Yeah? If you look at the tops in the past or even bottom projections in the past, you will always see a perfect fit if you go into historical data. But then let's use this example here. So on the left-hand side, it looks more or less perfect. You have a slight deviation of the tops or the bottom. But if you now take this projection into the future, you see that this top here is now more closer to this low here. So you really get wrong projections if you would use the static projection instead of using the variate projection. yeah, that's the principle of variation, just with some theoretical video. And this is the generic answer to your questions. That's why we are here on the channel, to every month or every week we adjust the cycle analysis and try to guide you what's in the current projection expected to happen. We don't look into the next year and try to fix the turning points which will happen in 2023. We are just looking what's the next important turning point. What's the current phase of the dominant or the composite cycle projection you're doing? That's what we're interested in. And then we are updating, and while we go, and cycles are, due to their dynamic nature, could change. Yeah, these have been the most important question I try to answer. First, configure in the settings if you use trading days, weekdays, and be aware of which data you load into the scanner. Save your profiles, which can make then a difference in regards to the projected turning points in the future, or which could explain a slight offset if you're loading new data and not adjusting the presetting. Second was, why have I picked a cycle with a flat plateau? Two reasons: because there have been no additional options in the spectrum. And the second answer is, based on historical analysis in Bitcoin, we are aware of that there's a nominal cycle of 200, which then gave us the clear specification: use the cycle even as a specific spectrum. It was more or less flat in Bitcoin. In Apple, I declined to pick the flat one because there have been 3 other options which looked quite good. So why use the flat plateau? And even I don't know, from an historical point of view of Apple, I don't know if this would be a valid chance. So that was the second example. And the third example, based on a comment on a video, if different updates are contradicting each other, no, they are just updates of the principle of variation of cycles. And these have been perfect examples you picked where the principle of variation, and we detected each variation in advance here, not after the fact. In advance, we have been able to pick the variation, and then this was what happened here. Yeah, 45 minutes again passed. I hope you, I don't, it's not boring here on your end. I'm just speaking into the camera here. But I picked these questions because these are very important questions. So thanks for raising these questions. Thanks for bringing them up to me. It's not wrong, your question you have achieved. You exactly discovered important aspects of cycle analysis. And I try to give you some background. There is no right or wrong. There is no black or white, but there is a clear framework how to read the spectrum, what to pick, what not to pick. And this knowledge is not a mathematic formula, which you can load into a charting application. This knowledge needs experience. It needs to repeat what we're trying here. It needs to raise your question, and it needs someone which try to give you the experience which we as the Foundation for the Study of Cycles have to speed you up. That's the purpose of this channel here. We want to provide knowledge on cycle analysis. Okay, so I think I will stop here. Maybe pause this video, maybe put this in your knowledge library, because there might be a time to review this session here in regards to dynamic cycles. Maybe it has been too much for you for today, so please excuse if it was very theoretical. But that's it for today. I see you have some questions here in the chat, so let me quickly check if there's anything. The default setting. Go to the watch list. Okay, I see some usability problems you're raising here. And so your questions are mostly regards to user interface, data update. Okay, so please excuse, I will not bring in the user experience or data questions. You're right, we need to improve a little bit the user experience still with some watch list and maybe Safari browser. I need to cross-check different browsers here. We will so thanks. We see your questions. We will review the user experience topics, but I think I will leave it for the afterwork instead of commenting live here. Thanks for today. Please continue bringing your questions either below video, send us emails with your questions. So you really see we take your questions serious. Maybe don't expect a speedy answer on your email, but we will really review your question and try to give you an answer. And if we think it's important, we bring it here. Have a nice week. I hope that you will join this channel today, next week, Monday, same time, same place. Subscribe, like, comment, as always, spread the news on cycles. That's what we're trying to do here. Thanks for joining. Have a nice week. Stay safe. Bye.